Thank you, Stephen. It seems the gloves are off in Kenya's telecom sector. Now, this is Safaricom and Zain Kenya battle it out, seeking to see who can cut their tariffs by the most. Now, Safaricom cut its tariff rate to 2 shillings a minute, making it the cheapest calling rate in Kenya. Now, that followed Zain Kenya cutting its rate by 50% to 3 shillings a minute. Now, analysts say Safaricom's move effectively cancels out Zain Kenya's price cut because 80% of Zain's calls end up on Safaricom's network. All this comes on the backdrop of the Communication Commission of Kenya, which halved interconnection rates last week. Now, joining us on the line to discuss these issues is Dobek Pater. He is a partner at Africa Analysts. Dobek, good afternoon, and thanks for joining us this afternoon. Now, you have got the two biggest players battling it out to try to see who can say they are offering the lowest rate. Do you get a sense that we have reached the bottom with the cuts that have been announced so far?
Good day. I think the price war has become fairly dramatic in Kenya. We're looking at something of equivalent of 25 to 30 South African cents per minute. So when we look at operational cost of operators on the cusp, on the margin of actually running a profitable operation at these tariffs per minute. But I think it also is not only a development directly, well, it is directly related to the reduction in interconnection rates on mobile calls. But that's only part of that. I think it also has to do with the strategy chosen by the two, I suppose you could call them Indian operators now in the East African market, namely Bharti Airtel, which acquired Zain in Sub-Saharan Africa, and the U brand, which is effectively managed by SR, an Indian company as well. And they have been, it's a business model they have been following in India as well to drive costs down and exercise or achieve a least cost model. In other words, you try to limit your input costs as much as possible in order to be very competitive on the retail tariffs. Now, the problem with that perhaps in Africa is that our input costs tend to be higher because of things such as lack of proper infrastructure, for instance, which forces you to power your base stations with generators.
Yeah, but can they go lower than they already have? Well, can any one of them afford to go lower than we've already seen?
No, I think we effectively have hit pretty much the rock bottom from a cost perspective, because if we go lower than that, we will start seeing operators running unprofitable operations, and then the question arises, if they don't generate profit, what is the future of network development in those countries? Because you can't commit investment if you're not going to run a profitable operation. And it also becomes, ironically, then a concern of the regulator, which lowered the termination rates, because they become concerned with the possibility of unviable mobile operations in the market.
Then the next question then becomes, so how sustainable are the rates that we currently have with Safaricom offering 2 shillings per minute?
Well, if we look at Safaricom per se, they offer these tariffs on a special they announced, which runs, I think, for about a month until the 23rd of September, if I remember correctly, which effectively means for them it's a very short-term move in the market at this point to see effectively a tug of war. Who's going to probably buckle in first? Is it going to be the competition, Bharti and SR, or the U brand, or is it going to be Safaricom? Thereafter, it's not unlikely that the prices will start bouncing back, maybe not to the levels they were at before, but back to something a bit more reasonable.
Yeah. Now, we have a country where penetration rates are around 50%. What kind of an impact do you see this having on penetration rates? Are we likely to perhaps see a quick run-up to the 100% mark because of these price wars?
We won't have a quick run-up to the 100% penetration rate. We certainly will see an increase in penetration, or more people taking up subscription services. That's the tariff, so it's the cost of the service on a, say, daily basis or monthly basis, but there's still a barrier to entry which prohibits many people from entering the market, and namely the handset, which you have to acquire, in most cases buy. And to buy a new handset, it's still at least $20 a handset, normally more than that. Second-hand, also you have to pay something to get into the market.
Yeah.
And as mentioned before, maybe these tariffs are not really sustainable. That's one aspect. Another one is for Bharti and you specifically. Yes, they're targeting the mass market, the lower end of the market with low tariffs as an attraction. The question is the quality of subscribers they acquire on the respective networks. Do they really want that type of a subscriber, which costs them maybe more to carry, to manage that subscriber than the actual revenue that the subscriber generates? So it could be, from Safaricom's perspective, could be actually a coup in the medium to long term, and that they effectively, whilst it allows other competitive operators to acquire more subscribers, they end up investing quite a bit more in order to provide additional capacity on the networks to retain the quality of services, but are not really generating the profits that they would expect. Meanwhile, Safaricom will continue to retain the high-quality subscribers, and they control close to 80% of the mobile market.